All right, good morning. Traderfirstyear here, and this is a bonus trade. The popularity of the earnings plays, I decided to add an additional one. I probably will do more if the popularity continues. So 4/16/2020, new options position, earnings bullish and bearish risk reversals. Traders will be short theta and long gamma profile. Expected outperformance from 4/16 to 4/17, taking advantage of earnings events before market open and market close on 4/16 and market open on 4/17. So traders do not want to buy until 3:55 p.m. today. You want to avoid the small print. Condensed version of the trade is pretty straightforward. It is a long vol via short front dated options and a long gamma profile. End goal is always to make money on earnings jumps. Potential is unlimited in profit. You will have some exposure of 295 this week, which is short dated funding to reduce the cost of the long vol position. Again, I want to stress, do not buy until the end of the day before market close at 3:55 p.m. Traders are targeting a move after earnings are reported this evening and also tomorrow morning. Volatility expectations on individual earning announcements. I expect the following implied moves in the underlying securities. And again, these are implied plus minus moves. SLB, which is Schlumberger, expecting a little bit over an 8% move. KSU, which is Kansas City Southern, expecting a little bit over 7.5% move. SKX, which is Skechers US, expecting a little bit under 6% move. And Procter & Gamble, which is PG, expecting a little bit, about a 4% move. And these are prices as of yesterday's close in this morning, so about 4/16/2020, about 8:30 p.m. or 8:30 a.m. The full summary and rationale for the trade. The start of earnings season allows investors to take on what I refer to as earnings bullish bearish risk reversals. These give investors the opportunity to sell premium to fund a long premium position and attempt to profit from an earnings event. The market pricing around implied volatility during an event week like earnings leads to wider elevated moves relative to historic volatility. These specific strategies will not be greatly impacted by implied volatility crush. These are purely 100% speculative, with no trader engaging in these trades with a clear absolute edge. Brief on trading suggestions. We will temporarily be returning to a period of elevated swings up and down, but there is more significant delayed selling likely to restart after April 17th. However, this overall market sentiment has relatively little impact on traders engaging in earnings plays. These are specific earnings picks where you stand to make an unlimited profit if you're right, or lose all premium paid to enter the trade. There is no strategic rationale, which makes the payout similar to buying a lotto ticket. You fund the trade by taking in income to pay a premium for the unlimited potential profit to the right or left side of a distribution curve. The rationale for the trade, just refer to the brief. The risk for the trade. The risk again is twofold on the first funding leg, which could be offset by a large increase in realized volatility, which causes the equity market to move up more than 5% to 10%, or in the case of a bullish risk reversal, the equity market to move down by more than 5 or 10%. The second leg of the trade, which is long volatility via long calls or long puts, faces risk if realized volatility falls or remains stagnant. If the implied volatility is substantially less than realized, the trader profitability could be hampered. What we would like to see happen is realized volatility higher than what is implied on the position we are long, put or call, and lower on the position we are short, used to fund the long position. Do not enter these trades if you do not want to enter into an events trade, which may require some quick management if the short position moves against you. The popularity of earning strategies is the low premium for a large unlimited skewed return to the upside on calls or downside on puts. Level 3 is required to write short naked calls or puts, which is sort of a requirement on this trade unless you just have the stock set aside or you have the cash in your account to fund it. Please look at the contract sizing, as this is not a one contract per one position. We did that. I did that in the first one and switched that up in the second one here. This is done to limit weighting differences due to large dispersions in underlying price of equities. For example, SLB, there's 10 contracts, calls, puts, and it's a bearish risk reversal. KSU has one contract, calls and puts, and it's a bearish risk reversal. SKK, our Skechers, has 10 contracts, in calls and puts, and it's a bearish risk reversal. Procter & Gamble, which is PG, has one contract, calls and puts, and it's the only bullish risk reversal where I expect the price to actually go higher. And again, the pricing in the picture below is as of about 8:30 a.m. and it's the close of business yesterday on 4/16. These risk reversals will be updated later in the day with the actual pricing that was taken on probably closer to about 3:45 p.m. So this is just kind of a look. Feel free to ask questions throughout the day. I've listed some links. If you like the information, you'd like to see more of the stuff that I put out there, there's you can follow me on StockTwits under Traderfirstyear. If you like the information and you want to donate, which will keep the content coming on a much more regular basis, on maybe a daily basis, you can go to the Patreon page and become a Patreon of Traderfirstyear. I also have an Instagram, which is Traderfirstyear. Just search Instagram and follow. And as you know, I'm on Reddit and YouTube. So thanks for following, and keep the questions coming, and we'll keep the I'll keep the trades coming out.